China just sold nearly $700 billion of US debt, and did it while taking losses. Why would the world's second-largest economy willingly burn billions in capital to exit the world's safest asset? Today, we decode the hidden mechanics of a 12-year strategic retreat that is reshaping the global financial order. If you want to understand the forces moving global power before the rest of the market, subscribe to Voice on Pages. To understand where we are, we have to look at how long this has been happening. This isn't a flash crash, it's a long game. China's holdings reached their all-time high in November 2013, surpassing $1.3 trillion. Since then, the trend has been one way. The reduction happened gradually, with notable step-downs after 2015 as Beijing began diversifying its reserve base. During the trade war of 2018 and 2019, the pace accelerated. China's role as the top lender to the US began to erode. Today, China has fallen to third place, overtaken by Japan and even the United Kingdom in their total treasury holdings. But it was the events of 2022 that turned a gradual reduction into a strategic exit. The trend became undeniable. Beijing isn't just selling debt, they are rebalancing the financial foundation of their national power. Over 12 years of deliberate withdrawal. To understand why China is taking losses, we have to understand the basic mechanics of the bond market. It's a simple but brutal logic. Bond prices and interest rates move in opposite directions. When market rates go up, the value of existing bonds falls. For a decade after the financial crisis, yields were stuck between 1% and 2%. That's when China accumulated the bulk of its reserves. But when yields rose to 4% and 5% in 2023, those old bonds became toxic. No one wants a 1% coupon in a 5% world. If you hold to maturity, you get your principal back. But if you sell now, you lock in that massive capital loss. China is choosing to sell. As market rates increase, existing bonds become less attractive, reducing their price. Investors demand higher returns, and the value of low-coupon bonds crashes. For Beijing, the financial return is no longer the priority. The cost of holding these assets has become a geopolitical liability. In February 2022, something happened that every central bank in the world noticed. The West froze $300 billion of Russia's foreign reserves overnight. This was the turning point. It wasn't just a sanction, it was the immobilization of a nation's sovereign wealth. The freeze demonstrated that sovereign reserves can be rendered unusable overnight by the political will of a foreign power. Most people think reserves are held at home. They aren't. They are digital entries in the ledgers of the Federal Reserve, the ECB, the Bank of England, and the BIS. This is how they can be frozen with a single keystroke. Using the IEEPA mechanism, the US proved that reserves aren't savings. They are conditional assets. They depend on Washington's permission. For Beijing, the message was clear. If you hold dollars, you are subject to the same systemic risk that crippled Russia's war chest. Exiting treasuries isn't just about diversification, it's about survival. Beijing is buying insurance against the day the dollar system is turned against them. Take a moment to process that. The world's reserve currency is no longer neutral. Now let's look at the alternatives. So where is the money going? First, gold. The People's Bank of China has added to its gold reserves for 16 consecutive months. Gold is the ultimate asset with no counterparty risk. It represents a shift from digital promises in DC to physical bars in Beijing. It is a move for geopolitical risk mitigation, minimizing dependency on external currency networks that can be switched off at will. Second, infrastructure. China is scaling CIPS, its own cross-border interbank payment system, to clear trades without touching Western messaging rails. This is already in action. China and Brazil have operationalized local currency trade, settling massive deals in oil and iron ore without the US dollar. But let's be clear, the dollar is still king. It represents roughly 58% of global reserves. We aren't seeing a sudden collapse. We are seeing a slow, logical diversification. China isn't attempting a rapid total exit. They are building redundancy, making sure that if the main door closes, the side doors are wide open. The implications for the US are profound. As China pulls back, other players have had to step in to absorb the increasing supply of treasuries. Japan and the UK remain the largest foreign holders, but an increasing share is being absorbed by private investors and domestic funds inside the US. In times of extreme stress, the Federal Reserve remains the buyer of last resort. But this systemic reliance comes with a long-term cost. Reduced demand from foreign central banks can put upward pressure on yields, potentially raising the cost of borrowing for the US government for years to come. We are moving toward a more multipolar financial world. The dollar is still dominant, but it is no longer the only game in town. Safety is being redefined. China's exit from US debt is not about a lack of faith in the dollar's value. It's about a fear of the dollar's power. Logic dictates their survival strategy. Capital doesn't have loyalty, it has logic. In a world of financial warfare, the safest asset is the one that can't be turned off. This is the new reality of global power. I'm Steve, and this is Voice on Pages. Support our work by buying us a coffee via the link in the description. See you in the next briefing.